A new report from AM Best projects modest growth in capital and surplus of approximately $48 billion for the U.S. life annuity insurance industry over the combined 2024-2025 period. Best Annual Review Preview report on the segment also states that balance sheets within the life annuity industries remain well capitalized and continue to grow. I'm John Weber for AM Best TV, and we're joined now by Director Ed Kohlberg, who's here to share some additional insights into the segment. And Ed, AM Best has kept its outlook for the segment at stable. What's the reasoning behind that?
Sure, yeah, so the outlook continues to be stable. We reaffirmed that at year-end 2024. We've been stable since 2021. There was a brief period in 2020 during the pandemic when we did have a negative outlook on the industry. But if you look at what we are keeping the stable at for this year, that's driven by a few things. We've seen very strong growth in premiums for the industry, mainly in the annuity line of business. If you look at total direct premium growth for the industry, it grew about 17%. When you look at third quarter 24 from third quarter of 2023, for that same time period, if you look at the annuity line of business, that grew 28%. So very strong growth in that line of business. Other things that have helped to support our outlook is capitalization continues to be strong for the industry to help absorb some of that growth. When you look at other metrics on the balance sheet side, we're comfortable with the stable outlook. When you look at investment allocations and you look at the investment grade quality of the investments, we're comfortable on that side. When you look at the operating performance for the industry, it continues to be profitable for most companies. We are seeing some increase in expense spend for technology and modernization of systems.
Now, the industry has increased its liquidity in recent years. How is that playing out?
Sure. When you look at liquidity, some companies have increased their facilities to help bolster their liquidity, such as FHLB access. Other things on the liquidity front, I think it's important to look at the ALM, the asset liability matching of companies, which has improved over the last few years. That's mainly been driven by the interest rate environment, as companies have been able to lock in longer with higher interest rates. That helps with their matching against longer dated duration liabilities.
There's been a growing role of private equity and asset managers within the industry. What are we seeing as far as that's concerned, and how is that working out?
Yeah, that's been an interesting story. There's been a lot of new players coming to the marketplace. Most of them have been entering the annuity space. We're seeing, private equity come in, asset managers, of course, and other type as well. Some, family-owned companies and other company types that have come into the market. They all bring to the marketplace their niche, their abilities and strengths. Specifically, asset managers, clearly have the knowledge and ability to manage the assets. Many of them have done so for other insurance companies on a third-party basis. So they bring their expertise to certain asset classes that help when it comes to the interest-sensitive, capital-intensive type businesses, such as annuities. Speaking
of asset classes, are you seeing any interesting trends as far as that goes? And real estate is one that comes to mind.
Yeah, there's been some interesting trends in recent years. Some companies are investing more in private, less liquid type assets as they see a better trade-off between the less liquidity aspects against a corporate, similarly rated corporate bond. The yields are better for some of the private investments that they're seeing. On the mortgage front, most companies are growing slightly on that aspect. We don't see any wholesale growth in that area. What we are seeing is companies maybe straying away from the structured CMBSs in favor of more of the commercial mortgage loans that they could manage and underwrite themselves, so they have more transparency into that asset class. Other things going on the asset classes, of course, there are other, I mentioned the asset managers. Some of them have their own esoteric niches in certain asset classes that give them the ability to invest in other type classes.
Ed, thanks for taking the time to speak with us today.
Of course, thank you.
That was Director Ed Kohlberg. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.